Hi, everyone. Welcome to our 21 shares analyst call. This is the last of the year, and we're very excited today because we have our research team with us. So we're going to give 1 more minute for everybody to join. But we're seeing a success rate because now we are already 40 people. Welcome, everybody. Welcome, welcome. How are you guys doing today?
Great. Can't wait for Christmas.
Good.
It's been a tough year, in my opinion. A long year. So yeah, getting ready for the end of the year.
That's great. Lina, Tom, how are you guys doing?
Yeah, feeling groovy, excited about this analyst call. Really excited about what you guys will say more than anything.
I like Lina's sweater. It's like the market going green.
Yes, exactly. This is the energy that I'm coming.
Yeah,
We have planned
well.
for this.
I am just bullish.
I'm in green as well.
If you guys have been watching the Bitcoin charts, Lina is the green candle pushing through 18K today.
Thanks to Lina. Thanks, Lina. Please wear more green.
So Bitcoin just broke through $18,000. Very interesting candle. Especially because it has been a resistant level for the past 6 weeks. So very interesting. But today we're not just going to talk about the price of Bitcoin. Of course, we're going to discuss the key lessons from 2022 and most importantly, our expectations for this year. So bear with us. But first, we want to give you a quick update on the whole FTX situation. And most importantly, what happened with Binance as well. So let's start with Binance because Binance is the less obvious, I think, elephant in the room, right, Tom? So maybe what I'm going to do now, and I want to make this, special analyst call very conversational, but we're going to share our screen to show you guys our dashboard for Binance and discuss what we've seen over the past 24 hours. So I'm going to share my screen and then we're going to walk you through what we've seen behind the scenes, thanks to the transparency, of course, of the blockchain technology. All right. So, welcome, Karim. Welcome, Carlos.
It's good to be here.
The party just got started. Don't worry, guys. So we built a dashboard on Gene Analytics, and we specifically built a dashboard to look at all the exchanges, addresses, where we are able to identify them. And most importantly, this is a lower bound estimation because these assets are only seated on the Ethereum blockchain. And as you know, there is also Solana, Avalanche, Bitcoin, and more. But let's look at Binance. So Binance, we know that they have essentially a lot of assets within their portfolio. They're really sitting into their stablecoin called BUSD. There is about $14 billion worth of assets at the moment of BUSD. However, Tom, can you tell us more about what happened with BUSD over the past 24 hours? Because we know now that the market cap actually dropped of BUSD compared to any other stablecoin, right?
Right, exactly. I want to give a little bit background about BUSD as well. So a few months back, Binance had a decision on auto-converting all the stablecoins, excluding USDT, auto-converting them to BUSD. So we've seen that over the previous months. We've seen that BUSD has grown tremendously in terms of the market cap. So basically from around 19 billion market cap, pushed up to around 22 billion. However, what we have seen over the previous days is there are huge withdrawals of stable coins from Binance. So what they need to do is convert those BUSD back to the stable coins that the customers are requesting. However, since the stable coins are issued by centralized parties, meaning that if they want to convert BUSD to, for example, like USDC, they will have to wait for a bank to open to transfer or to convert BUSD back to USDC. And therefore, we have seen, actual dollars, exactly. And therefore, we have seen that Binance actually halted USDC withdrawals for several hours. And in the meantime, we've seen that BUSD have been dropped in market cap quite a lot for around 3 billion. And who is the winner out of this chaos is USDC. A lot of the market cap has gone to USDC. So basically, their market cap has jumped around 2 billion within a single day, whereas Binance dropped for around 3 billion.
And again, what happened with Binance yesterday, because there was a lot of uncertainty and I think fear in the market, we want to reassure you with the data that we have that it was not the largest outflow ever for Binance, compared to what we've seen amidst the collapse of Terra and Luna, where there was, $2 billion in outflows from exchanges. Now, of course, that was at the peak of the fear of the collapse of Terra and Luna. So from what we have and what we gathered so far, this is not a bank run on Binance, and investors should rest assured of the situation of Binance. But again, we are closely monitoring the market. So that's for Binance. Then FTX. So FTX, a lot happened, and now we know actually that FTX built a specific software in order to basically avoid specific trades to be sent directly to their compliance team or directly to their finance team. And bear in mind that they had basically a handful of people in their finance team, but not even a CFO, nor a head of HR, and nor a head of IT, right? So from the testimony of the new CEO, who used to be the restructuring lawyer of Enron, one of the largest scandals in history in the aftermath of the dot-com bubble, heard yesterday that FTX is even bigger than Enron because of the lack of record keeping and the lack of, most importantly, compliance and control over the whole infrastructure. And for us, to be honest, FTX is really the entire crypto epitome, because at the end of the day, for crypto to be successful, it needs to be decentralized and not centralized in the hand of a handful of people. And most importantly, the data on the blockchain needs to be verified, and most importantly, cannot be counterfeited in the aftermath when the blocks are settled. So that's why for us, the unfortunate collapse of FTX is a great thing for the space to move forward with better actors and focusing on the innovative teams and respective builders in the space. So today is going to be a special event for us, because we're going to really discuss about what happened this year. And I'm going to challenge my research team, so Lina, Tom, Carlos, Karim, and Ram as well. I want to make sure that it's going to be a fun conversation that you guys, most importantly, will learn a lot. So we're going to start with the first questions. And I think it's going to be with you, Adrian. In your opinion, what was this year defining moment for the industry? It could be positive, it could be negative, it could be your base case as well, but tell us more, if you had to pick one specific moment.
I mean, for me, the highlight of this year was definitely the Ethereum merge. I mean, it was anticipated for so many years. And for me, it was one of the biggest events ever in crypto. And thankfully, it was successfully implemented. And for me, that's the foundation for a new wave of Ethereum upgrades, applications, and most importantly, scalability. What's really important for the merge was, for me, the change in tokenomics. Of course, when we talk about the merge, a lot of people focus on the energy consumption, because the move from proof of work to proof of stake is 99.95% less energy heavy. However, the tokenomics changed significantly. On proof of work, we had like an issuance rate of 13,000 ETH per day, while now we have, with the staking rewards, we have like 1,600 new ETH per day that come into circulation. And this, together with the burn rate, can make Ethereum deflationary. And what's really impressing to me is that it already has been deflationary, I think, in the middle of last month, even though we're in the middle of a bear market. So I can't imagine how this will impact not only the price, but just in general, the economics of ETH in the long run. And I think that's one of the most overseen in the future impacts that the Ethereum merge entails. I
think I would tend to agree with that. It was not my defining moment, but I would say that in the perspective of Ethereum, given the fact that the merge was an exciting event for many years, actually since 2014, even a year before Ethereum came out, the founder of Ethereum, Vitalik Buterin, was already talking about, moving away from proof of work and having a more energy-friendly consensus mechanism to verify the transactions and secure the network. And interestingly, the fact that the merge happened means that I think like when our bias, we're going to always think that they can deliver on time now, right?
That's the expectation.
That's the expectation, right? So what are you excited about for anything else, guys? What about you, Lina? What was your defining moment?
I have to say my defining moment in the past year was the ban of Tornado Cash in the US.
That's a very good one.
And for me, it really the defining moment about this event was that it restarted the conversation about sanctions and how sanctions will look like, or if there will ever exist in the age of cryptocurrencies and decentralization and freedom of ownership. And this really it's igniting a spark in me, and it's igniting a hope that I have for the world to not approve of sanctions, because sanctions as its premise is based on a very top-down approach. The philosophy is very different than what cryptocurrencies and what blockchain is all about. So that is something that I'm very excited about, and I'm happy to discuss later in this call.
So the result of Tornado Cash and the ban, specifically in the United States, so if you haven't followed, Tornado Cash is available across all the regions, but like in the United States, any residents and citizens cannot access that website. It's part of the blacklist. And of course, we know that one of the founders and contributors of Tornado Cash was arrested in Amsterdam, given the fact that Tornado Cash was a privacy application for covering, people's tracks on the blockchain, because the blockchain is very transparent, so we can track the flow of funds. And there were significant amounts of money laundering in the aftermath of hacks, right? More than hacks than anything else. But was it a positive, negative defining moment for you? What does that result in for the industry?
Yeah, at a glance, of course, it's a negative impact to have a Tornado Cash banned because of all the reasons that I mentioned. But it's also positive in the notion of sparking conversation. And I'm not talking about the conversations that we're having right now. I'm talking about conversations that are happening within policy makers and regulators, and the questioning of this ancient concept of controlling money. You know what I mean? This for me is the real impact. This for me is a real defining moment.
Very cool. Very, very interesting. What about you, Carlos?
Well, thank you, Ellie. Let me just say, for me, 2022 was a very eventful year, so it's very hard to pick one moment. But if I have to pick one moment, I think it's the FTX debacle. Even though it's a negative event, I think it reminded us why we are all here. And I think it's better that it happened this way today, like just rip the Band-Aid off, as opposed to in a few years when the scale will have been much larger, because due to what has come to light, it was inevitable in hindsight due to what they were doing. So better to have the Band-Aid ripped off today than in a few years when the scale will have hurt a lot more people. This industry was born out of cypherpunk ideals, as you mentioned in the beginning, with the hope of a more transparent, fair, decentralized financial system. And I think that this centralized point of failure and this fraud represents everything that this industry is trying to solve. And I think this reminded of what we are building towards, and we will continue to build towards this vision. And I think that this is why it's such an important moment.
Absolutely. So what do you think, Tom?
So for example, like 3 years or 5 years from now on, if I think back what happened in 2022, I will also remember the crazy explosion of different centralized entities. For example, FTX is the largest one, and BlockFi, Celsius. And the reason why I think I will remember these events most rather than the merge, right? For example, I believe in the future, Ethereum will continue to make impressive developments, impressive upgrades. They will continue to surprise us, right? However, this year will lay the groundworks or become the wake-up call for a lot of people, for the community, to understand we should do better due diligence, to do better risk assessment. So I believe from now on, we hopefully will not see that large scale of explosion in future, because this year it reminded us we need to do better assessment, lay out the best practices in the future, governance practices. So in the future, like we'll follow these procedures and build up more better infrastructure for the community.
Very interesting. Do you see anything that for you was a defining moment in terms of like not the event itself, but like specific developments that were defining for this year that may plant the seed for the next one, for the next cycle?
Yep, definitely. I see, because NFT market is continues to grow, but right now it's still relatively small. For example, the largest NFT collection, CryptoPunk, compared to the token like ERC20 token or like crypto token market cap, like CryptoPunk, according to its floor price, it is around 800K in market cap. So in terms of collection, it is still relatively small. But in the future, if we see more adoption, I believe the NFT market will still grow much larger. And my point is, we have seen in this year where there are a lot of more innovation in terms of how to leverage NFT in terms of providing better liquidity for these NFT holders. For example, we have seen NFT AMM model, which is the NFT automated market maker. So users can trade more efficiently in terms of using the AMM model. They can trade in real time, such as using the model of Uniswap V2 or V3 they are using right now. And in the meantime, we have seen that the 2022 this year also launched some experimental new protocols like NFT borrowing and lending protocols like BandDAO, NFTFi, and these platforms can allow NFT holders to leverage their NFTs and provide them with liquidity they need, because NFT is going to be a huge market in the future, and these infrastructure and these protocols definitely provide these holders with the services they need.
I think it's a good segue with Kareem now. If you had to pick one event, one moment from 2022, by the way, his name is not Tom, that's a glitch from Zoom. His name is Kareem, but welcome to Tom 2.0. Kareem, can you tell us what is your favorite moment? It could be negative or positive, but that was a very important one for our industry.
Well, thank you for having me, Ellie. And yeah, disclaimer: Tom might be my Western name, but it's not my original name. There again, as Carlos and Tom have already laid out, there were a lot of things that will really shape this industry moving forward. But I'm going to take the path of doubling down on what Lena started, the conversation of the Tornado Cash sanctions. I'm not going to be talking about the impact on the regulatory landscape and how we are thinking about the viability of sanctions and what it actually means, the kind of value that it instills. However, I'm going to be talking about the fact that it made us realize that we cannot really have a decentralized network or a decentralized ecosystem without having a properly decentralized infrastructure that underpins it.
Yep.
And what do I mean by that? What do I mean by that is that, for instance, Ethereum, like we know that the nodes are globally distributed around the world. However, in order to interact with any Ethereum-based application, there are two ways that you can do that. You can either run your own node, which is quite costly. It requires a lot of maintenance, and it requires just really a lot of supervision on one's end, as opposed to relying on what we call as node providers. Node providers would essentially be third-party services. They could be either centralized or they could be decentralized. And they essentially allow you to connect, to translate users' actions on chain. So what does that mean? If you're trying to swap, if you're trying to execute a swap between ETH to USDC, you are sending a request to the node on the blockchain in order to execute that transaction. And surprisingly, not surprisingly, but what people didn't really realize is that Alchemy and Infura, two of the biggest centralized node provider companies in the space, they pretty much control the vast majority of all the transactions that happen on chain.
Yep.
So when we saw that the Tornado Cash sanctions, we realized that essentially because they had to be compliant with the Treasury's OPAC sanctions list, essentially anyone that was trying to connect to the Tornado Cash, they blocked any kind of interaction with the smart contract itself. Well, what is the alternative of it, or how can we move forward from that? Relying on decentralized providers. Those would accompany things like Pocket Network, it's a decentralized RPC network, or it could even make us look at Anchor. Both are, just decentralized RPC endpoints that are not under the mercy and under the control of one centralized company that would have the ultimate say of what on-chain entities we are able to interact with. And I think that this is really crucial. RPC is not the only point, but I'm just to give more space for the rest of our researchers. It's a really critical point that I don't think a lot of people were aware of. And an actual testament of that is that Infura, Consensus is planning to decentralize Infura, which is its biggest centralized offering. They are planning to transform it into a decentralized network in order to live up to the ethos and the standards of crypto. That it shouldn't be one company essentially determining how we interact on chain.
So basically, like what you're saying, to summarize, is the pinpoint moment for you this year has been the Tornado Cash debacle, which basically drove home the importance of the decentralization of the infrastructure that nobody really cares about, right? It's like using the iPhone or the Samsung, and you're trying to poke around with these applications. You're not really trying to understand how the App Store terms of service are working, how the iOS itself works. And what Karim is talking about is basically the back-end infrastructure that is very important for having a seamless experience for billions of people in the next few years, that of course they're not going to realize that they're using a decentralized network that actually we take for granted today to have our Zoom call, right? So no, that's very true. I think Ram has issues with his internet connection, so we won't be able to ask Ram any questions. So we're going to have a good segue to the next question that I have for you guys, which is on the back of the first question, and that's for you, Adrian. You're next. What is the prevailing lesson from this year that you think investors should always remember as they go to the next cycles? Because there's always like some key lessons that we learn as we go through specific experiences, right? For myself, I've been in crypto for the past 8 years, and there were always some key lessons in the bear market of 2015, in the bear market of 2017, 2018, and of course the one that we're experiencing right now. But if you had to pick one lesson, one prevailing lesson, what would it be? If you had like a notebook and say, like, I wish my kids and grandkids would remember it as they go through the next cycles. Tell us more.
It's sort of a sophisticated advice, but learn how to take profits. That's my biggest lesson, I would say, and it should be automated. Before a bull run, you should have a game plan and definitely stick to that game plan, because in my opinion, the emotions during a bull run, they run extremely high, and there's so much going on that you really get detached from your original plan. Greed is kicking in. Like FOMO, fear of missing out, and at one point you simply not gonna stick to your original plan. Markets dip, you think it's coming back, but it's never coming back, and then you just ride it out. So that's just another personal lesson for myself as well. It's also I've been in crypto for many years.
Yeah.
I thought I'd do better this time around, but yeah, it's really hard to stick to a strategy, in my opinion.
So the key lesson here is to be disciplined.
Absolutely.
And having expectations for your portfolio.
Yes. Yes.
I think this is the key lesson from Adrian. And of course, that's a disclaimer here. None of that is financial advice or nor legal advice.
No,
right?
absolutely. Absolutely not.
But that's great. What about you, Tom? What is the prevailing lesson that in the next 5 years or a few years, you would always remember?
Right. I will remind myself every time from now on, don't trust when you can verify, right? Because why we are in this blockchain or Web3 world is because blockchain is transparent. So every time we can, when we have a question or when we see some news online and we have a question, we can definitely go on the blockchain explorer or definitely the dashboards we built to understand what is actually happening on chain. And in the meantime, you have to understand that you can't really judge an entity by its size to decide whether you trust it or not, because nothing is too big to fail, especially when you have the tools, when you have the blockchain design right now, everything you can verify. You don't have to trust anyone. You can verify it on your own and make your own judgment call, especially when you saw SBF having a curly hair, innocent face, but actually he could be a crazy criminal, right? So definitely don't trust anyone by its background, by its size, even though it could be invested by big companies. But in the meantime, you have to do real due diligence, because blockchain provides you with the tool and infrastructure to do that. So from now on, everyone, if you are into blockchain and crypto, definitely dig into Blockchain Explorer and the dashboard we built.
And I think that's a key lesson here as well for everybody. And Carlos said it best to say that crypto is basically having a regression to the mean, going back to its grassroots of the cypherpunk movement to make sure that we can use the tools that are transparent and available for everybody 24/7, which is the blockchain itself, where we can verify actually what's going on to try to be illicit use cases, to understand any anomalies. And I think the key lesson here is that crypto is basically going back to where it's been in the first place and why it's important. And on the back of that, with the collapse of many lenders that we've seen with the contagion risk of Luna and Terra back in May, and then now FTX with even protocols like, for example, Project Radium or Serum, should I say, that were actually heavily centralized. They could be built on the decentralized infrastructure, but the people that hold the keys are actually just a handful of people. And unfortunately, they may have also a contagion risk with an entity that was helping them to develop the project, like Alameda, right? So again, I think the key lesson here is that crypto is meant to do what it does, and we've seen DeFi has been actually almost unstoppable, despite some of the largest events that we haven't seen for many years in crypto, especially at that size. Billions of dollars wiped out for specific projects like Terra and Luna, and of course FTX. We discovered yesterday that they had 10 million people on their platform. About I believe 7 million people on FTX International and about 2.5 million people on FTX US, their US entity. And of course, they had more than 100 entities across the world, in Japan, in the Bahamas, and
then they use QuickBooks.
And they use QuickBooks, of course, for accounting purposes. But no, that's true. It's a very good point, Tom. Maybe you stole the key lesson from Carlos, but who knows? Maybe he came up with something else. Carlos, what do you think?
No, I will definitely double down on what Tom said, but I think it's so important that it doesn't matter that it's the same lesson. I think that this will be a reminder, as you said, Ellie, to go back to crypto's roots, to remain. The lesson is basically remember why we are here. I think I will also echo some of Adrian's thoughts. In the bull market, it's so easy to get caught up in the euphoria and just get caught up in in very speculative things. Like we had, for example, Olympus DAO with like 3,000% APY, or we have NFTs of rocks being sold by $1 million. Like it's just crazy things that when you look back, you wonder, how could I have think that this is like why we're here for, right? And so I think that the key lesson is to stay grounded and to actually remember why we're here, and to continue supporting applications that are just contributing to that future that we envision, that is just more decentralized, more transparent, and yeah, just what we set out to build in the first place.
It's a very good point. What about you, Tom 2.0? Curious.
It's again, there are really a lot of lessons, but I think there is a very relevant one to the Web 2.0 system that we were used to. We were the product in Web 2.0 platforms. When we were using social media applications, we were providing the data ultimately, which is what companies were using to monetize, and that's essentially how they survive. One of the prevalent themes that we've seen since the beginning of this bear market, which has really just been this entire year, if you don't know where the source of the yield is coming from, then you probably are the source. Token emissions, unorganic token emissions, when you are essentially trying to incentivize users by printing a scary amount of tokens throughout the year, well, this ultimately dilutes your holding. And I know that we might be deviating a little bit to just talking about crypto, but it's like crypto, and rather than disconnecting it from the fundamental value of blockchain systems, but it's a huge part of the ecosystem. If you don't know where the yield is coming from, you probably are the source of that yield. So I think this is something that is going to be super critical, and that's why I think that DeFi will really enter a whole new era, the narrative of real yield. How our projects are able to sustain, how we're able to provide a sustainable yield. Yeah, I do believe that this is going to be the next phase in DeFi, which will involve the tokenization of real world assets. Sure, it will not happen over the short term, but I do think that this will be the next major milestone for DeFi to tackle.
Yeah, no, it's a good point. And I think to put it differently and to give more clarity to the audience here, what Karim mentioned is essentially in DeFi, many applications have to bootstrap the liquidity. And in order to bootstrap the liquidity, sometimes they don't have professional market makers to provide, liquidity on the order book. So it means that they get retail investors to provide the liquidity, but they have an incentive for that, either through transaction fees or trying to emit their new tokens in order to reward the early market makers, retail market makers on the platform. But also that means that basically the token is highly inflationary, and that dilutes, of course, someone's investments. So understanding the economics and understanding where the yield come from is to the utmost importance from a portfolio construction perspective. And that's even more so, I would say, the real yield is also underscored to the fact that there is also over risk attached to the yield, right? You can have a high yield of like 10, 20%, but there is also, technological risk with like smart contract vulnerabilities that are not part of the equation, and they should be, because of course, some of these new technologies are not yet to be battle tested and verified, even audited, right? And that's why we've seen in DeFi that a lot of hacks happen, given the fact that the application was not audited by security firms, right? So risk management would be definitely, I think it's like one of the key lessons from this year, of course, and we've seen with the implosion of Terra and Luna, and most importantly, of course, like centralized servers and providers like FTX. The good thing with DeFi, as Karim mentioned, is the transparency, where we can actually verify what's going on behind the scenes. thanks to, of course, the blockchain technology, and trying to combine that insights into a comprehensible way, thanks to our dashboards as well. So if you're excited about getting to know what's going on behind the scenes, let us know. We're going to send you guys the link to our dashboard. Some of you already attended to our analyst calls in the past, and you have the links. But that's very important because that ties back to our 21Shares, which is to make crypto easy. And making crypto easy means that anybody needs to understand ahead of time what's happening in the market. And that's really our mission here, to make sure that you, the investors, stay informed and we stay as objective as possible to help you navigate in this asset class. So Lina, what was the key lesson for you?
Well, the key lesson for me was a bit twofold. I'll try to be a bit more conservative in my answer to like shrink it and fit in the timeline. But the key lesson for me is that never underestimate the power of education. And why do I say that? I say that because so in 2022, we've seen how crypto can adapt to regulations. And what we've seen really is what really harmed the industry was not the bans. It was more of the infrastructure, the underlying, the back end, like Karim alluded to. And that's what really harmed the industry. The bans are detrimental, sure, they're harmful, they impede innovation, but it does not harm protocols like, for example, Tornado Cash to the root. What I'm saying is that in 2023, I hope to see education really make a footprint in Congress, in Europe, European Council, in terms of how regulation can actually adapt to crypto. How can we unlearn the old ideas, you know, and that is something that I'm really looking forward to in 2023. It's one learning and it's one wishful thinking.
Sounds good, and that's a good segue to actually our second section of this cool panel. Thank you so much, Lina. It's what is your non-obvious prediction for next year that very few people pay attention to? And then I want you to answer that with two scenarios, your bull case scenario and your bear case scenario. So we're going to start with you, Lina, and then Adrian next. But like something that is unconventional that very few people pay attention to, hidden in plain sight, as Peter Thiel says in his 0 to 1 book. It's an amazing book, by the way, if we have some startup builders in our audience.
Okay, so one thing, one non-obvious prediction for 2023 is that a lot of countries like Paraguay, who are rich with oil, for example, and even better, renewable energy, will really step forward and try to make benefits of the real problem that Bitcoin miners are facing today. And they will try to monetize, like take up part of that pie. That is something that I am hoping, and I'm also seeing that is feasible, because we have, if we stick to the facts, we have all these foundations that could fruit this expectation, especially that the world only utilizes renewable energy by 30%, so 30% of our electricity supply comes from renewable energy, and we have the potential of having the 90% of the entire world's electricity supply from renewables. And countries like Kazakhstan, for example, only utilizes 1% of its renewable energy, as opposed to, and it actually has the potential to cover its entire costs and have a surplus. So I'm seeing a lot of potential that is still unlocked, and people are still scared to tap into. And I think 2023 will be the year for more countries like Paraguay to step forward and utilize these resources.
Very interesting. So you see definitely the Cambrian explosion and convergence with digital assets, and I would say including proof of work miners to leverage renewable assets. So that's your prediction to to have a higher rate of renewable assets. Of course, that's a data that is not easily to find. So we're going to hold you accountable by the end of next year.
Up for it.
What about you, Adrian? What's your non-obvious prediction for next year?
I mean, I have a lot of ideas, but maybe this one is a bit more opposing. Actually think a Bitcoin spot ETF in the US is closer than a lot of people think, and it might already happen end of next year. Because I was always of the opinion that it hasn't been approved in the US yet, due to the fact that on an infrastructure layer, or like, let's say in terms of custody infrastructure, the big traditional banks were not ready for it yet. Meaning if they would have launched during, let's say, October last year, most of the flows would have gone to Coinbase. Plus, all the institutional investors would have bought at very high prices. But launching it now when all the traditional banks are ready for custody, plus in a bear market where Wall Street can get a juicy entry into the asset class, for me, it just makes so much sense. And we see the beginning of that. We see BNY Mellon implementing crypto custody, the same for Fidelity, digital assets. We have Franklin Templeton that works on custody solution, Citibank that works on a partnership with Metco. So I see more and more, custody infrastructure being built for those traditional US banks. And that's for me the foundation for a Bitcoin spot ETF.
I think the other point is, when you talk about that specific angle for, what's going on in the US, we know that there is a lot of uncertainty, of course, for as to when this may happen. But the fact that there is, more than 60% of the traded volume coming from overseas, when there is no transparency on the order book for some, counterparties, we've seen with FTX, for example, that may delay, I think, like, how comfortable that is for US investors to have access to just like a handful of exchanges compared to more exchanges based in Europe or more exchanges based in Asia. But I think that would be interesting to see, like, besides custody, how exchanges are going to service US customers. And of course there is like a regulatory framework available. They have to have the money transmitter license in specific states to operate there. They have to comply with FinCEN. But I think that's a very interesting angle.
I mean, it's just funny how they can have a derivatives product, a future Bitcoin ETF, on the very same underlying they had doubts about. So it doesn't make much sense to me.
Yeah. But the futures are cash settled.
Absolutely.
Of course, not
but still,
like exposure to the underlying.
Yes.
It's a fair point. It's a fair point on the developments on the custody side.
And I think the FTX debacle also put more pressure, because I think a Bitcoin, or like the ETF or ETP structure, is one of the superior structure when it comes to investing in cryptocurrencies, because you don't have that. You kind of mitigate your counterparty risk because you have a diversified. Exactly. So for me, so for me, the ETF, ETP structure, and of course self-custody are the two ways to invest in crypto. Yeah.
What about you, Tom?
I think the next year we will see much more huge brands getting into NFTs in terms of launching the membership using blockchain and rolling out their own NFTs. It seems like a narrative that everyone is noticing already, but then what people are noticing is the data underlying. For example, we've seen that the Adidas into the Metaverse collection has already brought in 10.4 million in royalties. And for example, on the other side, Artifact, which is a company under Nike for the largest collection, Clonex, which is a art collectible collection, they already brought in around 15 million royalties for that company. And you have to also think this is a sustainable revenue stream, because whenever there is the traders trading on secondary market, you will get a share of that royalties. So right now we're just seeing the beginning of different large brands like Tiffany & Co, Gucci, Reddit are testing out the market. But in the future, when they see the opportunity here, they would definitely adopt and rush into the bandwagon, jumping on the bandwagon to provide more NFT collectible. But then on the flip side, which is the bear case, is right now we are seeing different NFT marketplace ignoring the royalties. For example, like Blur, LooksRare, X2Y2, they're omitting royalties. And therefore, they would definitely hurt the creators. In the meantime, also hurt the brands if they launch the collections and trading on these marketplaces. So that's my bear case. But in the future, I'm sure that we will have a solution. For example, OpenSea already is addressing this problem by launching the royalties tool to ban the trading on these marketplaces that don't enable royalties. So let's see what the market leads us in the future. But that's my bull case and bear case.
And that's interesting because you talk about NFT marketplaces, and interestingly, there's also another format for trading NFTs, which are called aggregators, which basically combine all the marketplaces into one interface. Uniswap started with ERC20 tokens like Ethereum, Bitcoin, and the long tail of crypto assets, and now actually they have an aggregator for NFTs. My non-obvious bet for next year, of course, it's not financial advice, is that aggregators are going to have a stronger moat, so a stronger defensible business model to a single marketplace. Because again, like when we talk about the infrastructure underneath the marketplace, if goes down, it means that we cannot access OpenSea. However, if you're using an aggregator, it means that there is other marketplaces where you can access and trade these assets, right? So I think like it's going to be very interesting to actually see how the volume is going to evolve from the NFT marketplace of Uniswap, because they aggregate all the NFT marketplaces. And on top of that, how they can build risk management filters in order to basically, for example, have signal on wash trades, signals on, let's say, a specific marketplace has been, completely hacked, right? Because there are some interfaces that also could be looking like Uniswap based on uniswap.com or uniswap.org is something else, right? So having like these risk management filters is going to be super important. But my bet on what you just said is that marketplaces are going to have a stronger defensible business model going forward.
Like aggregators.
I mean, like an ETF structure is an aggregator.
Yeah, I wanted to say you're betting on basket solutions versus a single tracker, right?
No, I wouldn't say that.
No, I
wouldn't say that.
The aggregator aggregates all the underlying.
Yeah, NFT marketplaces.
Yeah, that's what I mean.
But like you can buy, for example, there's a Bored Ape, or you can buy like a NFT from Adidas or Nike from like LooksRare if there is like a better price slippage.
Absolutely,
right?
It's a metaphor that
you're not.
You don't depend on one
Exactly.
single underlying marketplace. You source from different
marketplaces,
Yeah.
And that's exactly what market
like
makers
it.
do for an ETP structure or an ETF structure, right? And that's better if like one goes down, then you know that you didn't lose your coins or your NFTs. And most importantly, how these NFTs are retrievable on the blockchain is super important as well. Because if, for example, you have a data center going down or being hacked, and the metadata of the NFTs are only retrievable on that data center, it means that your NFTs are gone, right? So having a decentralized infrastructure as well, Kareem, sorry, because I know you want to talk about this as well, but like to segue what you mentioned, Tom, because we talk about NFTs and marketplaces, like for me, like the aggregators are having a more defensible business model. So hold me accountable for next year. And for me, in my opinion, NFT marketplaces and aggregators are going to have more volume compared to just OpenSea or to just LooksRare. So let's see if I'm right next year.
We call Eli internally, we call him Baba Vanga because he's been pretty good in just like anticipating what's happening in the future.
Sounds good. Carlos, what do you think? What is your non-obvious prediction for next year?
Well, my thesis is that non-speculative use cases will drive the long-term growth of crypto and DeFi. And so with this in mind, I think a vertical that very few people pay attention to is the real-world asset vertical within DeFi. So I think that in the next year, the intersection of DeFi and NFTs will emerge as a major trend. Just as this year, for example, we have, or last year, the L1s, next year, DeFi and NFTs will be a major trend, and we are already seeing indications of these. For example, Roofstock on-chain conducted the first property sale via OpenSea by tokenizing the rights to the house. We also have protocols like, for example, Centrifuge that represent off-chain assets on-chain via NFTs. So I think that this trend will continue. And what I would add is that this will spread first through underserved populations. So this will be first through sectors that are underserved by incumbent capital markets. So for example, the trade and supply chain finance industry has an estimated gap of $1.5 trillion per year. And so there are already firms that are working on tokenizing, for example, freight invoices on chain to try to reduce these gaps. So I think that this will be a very pervasive use case for crypto to incur into the real world. And my third case in this case is that regulations will definitely represent a threat to the adoption of real world assets. And this is the result of like two vastly different consensus mechanisms. So you have the blockchain and validator enforcement, and you have the real world and a web of like legal contracts, right? And right now, not many jurisdictions are recognizing real world assets tokenized as bearer assets. So I think we still need to work on the regulatory front and follow the footsteps of jurisdictions such as, for example, Singapore, which has a very pro-crypto regulation, and for example, Switzerland. So that's my prediction for next year.
And that's interesting because we've seen that the Monetary Authority of Singapore, so the central bank and also the regulator of securities, there actually launched a securitized transaction and tokenization of Japanese yen and Singapore dollar, not on the Ethereum blockchain, sorry for the ETH maxis, but on the Polygon blockchain. So that's very interesting to see.
And in conjunction with JP Morgan, right?
Yeah, of course, in conjunction with very respected financial firms. So I think that's very interesting as well. We've seen that because you talk about Switzerland, we also have seen that the Bank of International Settlements, called the Central Banks of Central Banks, is exploring the tokenization of Swiss francs and other fiat currencies using the technology behind Uniswap called Automated Market Maker, right? So that's really interesting to see that some of these, more crypto-friendly regulatory environments are the ones actually pushing the frontier when it comes to using the latest technologies that actually would be very important for the next cycle. So that's very interesting to see that happening, especially from respected regulators and financial institutions. What about you, Karim? You're the last one.
I've been contemplating this for the last 5 to 10 minutes because I'm really split on which one I should go with.
That's why we were seeing your screen like changing tabs, things like that. We knew you were just like looking at the thing that you were trying to say to drop the mic. I know you've been cooking something for the past 10 minutes, right?
Okay, I'm gonna try to contain myself. So originally I'm a Chainlink Marine, and if no one understands what that is, it is being a huge community, a supporter of the Chainlink network. For people who don't know what Chainlink is, it's the decentralized Oracle network. It's essentially the protocol that helps us bridge off-chain information on-chain. So just to cut things short, the main side of the business that Chainlink was involved in was price feeds, essentially either creating price feeds for commodities in the real world, or aggregating crypto asset prices from a lot of different exchanges, packaging into one feed that applications that can integrate or can plug into their logic, and then enable DeFi to emerge. So the reason why I'm quite split on this point is that Chainlink has TCP, cross-chain interoperability protocol, which is essentially what will allow the bridging or the cross-chain transfer of information as well as tokens. My belief in this point is that if CCIP does launch within the next 2 quarters, then Chainlink will start to lose its dominance over the price feeds vertical. And I think that Uniswap will be the beneficiary of this movement.
That's
However,
Yeah.
I agree, which I agree. I'm coming to agreement with as time goes, to be honest. But again, it's
Yeah.
dependent.
I convinced you. All right, that's good.
Yeah. You've managed to convince me of a few things over this last year, to be honest. But again, this is dependent on how CCIP takes off. If it does take off over the short term, then they will. It's a lot more lucrative business. It's the biggest issue that the crypto industry is facing. So it's really dependent on that. So if we look beyond that, what I think the other thing that people are really not paying attention to is decentralized storage networks, specifically storage networks that offer permanent storage, aka Arweave. If we go and look back at the Ukraine war, this was really it was a really eye-opening moment. The fact that when the war took off and then Russia started censoring the flow of information within the country, it is of absolute importance and significance that we have an impartial ledger that would store all sorts of media and documentation and data as much as possible. History is written by who gets to decide it. And if we want to have an impartial view of what happened over throughout our history, we really need an impartial and an unbiased ledger that would not fall under the mercy or under the pressure of governments, or however you want to call them. And even though this might be deviating a bit, permanent storage is really this has something that has not been technically feasible in the Web2 landscape. It was not specifically due to cryptography, and the fact that if you're just going to look at the use case of NFTs, and everyone knows what NFTs are, but what the thing that people don't realize is that NFTs just contain a pointer to where the data is stored, but then surprisingly, the vast majority of this data is located on centralized servers. So if you do want to have NFTs that will exist as long as the internet exists, you cannot be storing it or locating it on centralized servers. You want your NFTs to exist for perpetuity. And that's why I think Arweave is going to be a huge winner of that. And it's also echoed by Facebook and Instagram's decision to store their new NFTs on the Arweave blockchain.
Yep.
I think it's a huge testament to that. And yeah, I really do think that this will be a huge topic of conversation for and adoption really for next year.
It is fascinating, and we're already at time. Can we agree on the definition as to when the bear market will end? So my definition from a price perspective is that we have sustained prices above the cost basis of the average investors over the past 13 years for Bitcoin, right? And we can measure that on the blockchain, and that's around today $22,000, $23,000, right? Well, how would you define the end of the bear market? And we're at time already, but I just want to pick your brains here. You don't need to all participate, but again, do you have any thoughts here?
When the bear market is over?
In terms of price levels. So for me, it's like above the cost basis of the average investor.
Yeah.
Above, of course, the cost of production of miners.
Yeah.
When you look, of course, at the price of Bitcoin specifically.
Yeah.
But how would you define the end of the bear market if that, of course, quantifiable?
My personal, so first of all, a given has to be that the Fed stops raising interest rates. Obviously, markets are leading indicators. So once they stop raising interest rates, it already will spur an anticipation of the bull run.
Besides the macro environment.
Okay.
Right? Because we know, of course, that crypto has been highly correlated to geopolitical conflicts and macroeconomics situation. But what would you use as a proxy for measuring the the inflection point to the end of that bear market?
Yeah. Well, in that case, I would be more technical and look at Bitcoin's move above the 200-day moving average. And best it should be together with a golden cross. So when the 50-day moving average crosses above the 200-day moving average, that's a golden cross. Plus the price being above a level of the 200 MA. For me, that's a sign when the bear market is over, officially over.
Okay, and that's for like the long tail of crypto assets as well.
Yes. Yes.
But bear in mind that that's also my prediction. Some of the crypto assets are yet to be battle tested, which means that they haven't yet experienced an existential crisis, as we've seen with Ethereum in 2019 or even Solana this year, right? So they may face the largest drawdowns for the coming years if they haven't experienced a significant crisis. But that's of course for the novel verticals and technologies. Maybe Carlos, you can give like one last comment before we end this call.
Sure. For me, I would go, if I had to go with one indicator, I would go with the net unrealized profit and loss indicator. So right now,
so basically the confidence of investors.
Yeah, it basically measures the profit and loss of Bitcoin investors. And I think that when it crosses the line between hope and fear to optimism, I think that's we're in the bull market. Historically, that has indicated that we have entered a bull market that happened in 2019. In 2019, it happened in 2020 after the COVID crisis. So I think that once we are out of the capitulation and hope and fear phase of the NUPL ratio, we can say that we have started the expansion of the early innings of the bull market.
And for how long it needs to be sustained to declare that, okay, this is a signal to look into? Adrian mentioned the 200-day moving average. Would you wait for 200 days to see a sustained level of above that specific sentiment?
I don't have a clear timeline, to be honest. I think a 200-day has historically been a great indicator because we can have like 3 months of upwards trending movement, but it can just be a bear market rally. So I would say that 200 it's a good rule of thumb.
And also bear in mind, and that's one of our last comments here, crypto changes almost every day, right? So almost like having a 30-day, moving average or 90-day moving average is definitely not enough, especially when we look at a pattern that is sustainable, right? But I want to thank you guys so much for joining our call. We're already at time. We're past actually our limit here. But I want also to thank the entire audience for joining us. That was our last analyst call of the year. We're super excited to have you as part of our community. If you have any questions or comments or concern, feel free to reach out to our research team. We're very responsible and most importantly, responsive to your requests. Feel free to also sign up to our newsletters, both on 21.co, but also on 21Shares. 21.co is our parent company. But we hope you enjoy the session, and Adrian, Lina, Karim, Tom, or I would say Tom 2.0. Thank you so much for joining. I wish you a wonderful day and enjoy the holidays. Thank you so much, everyone.
Thanks, everyone. Happy New Year.
Thank you.
Bye-bye.
Bye.
Happy New Year in advance.